Hello, welcome to Any Answers Answered for October 2018. Tim and I have been having a look through the pages of accountingWEB, the Any Answers pages, and we've come up with a couple of questions that we want to have a closer look at. The first one, Tim, is asked by Arthur Allen, who has a question about probate value. If a house is valued for probate at, say, £500,000 but sells for £550,000, is the extra £50,000 charged to CGT or IHT, and at what rate? Various other questions that he then sort of goes on to expand upon, but that's the fundamental question. So let's answer that.
Yeah, I think let's answer one of the supplementary questions first. He says, is it possible if there was a general election and Labour won and decided to remove the extra property relief for IHT, that it could affect someone who has already died? Well, if you're dead, you're not bothered, for a start.
Very true.
But I know what he's getting at, and the basic answer is no. What he's asking is, could the residential nil rate band be withdrawn retrospectively? And, well, anything could happen, but I do not think that any government would ever come in and make retrospective legislation. So no, once the taxpayer has died, then I don't think there's any prospect of there being a change in the legislation. Now, the legislation here is very clear. On death, the assets have to be valued for probate, and that value is then the base cost for any subsequent disposal, either by the personal representatives or the beneficiary who receives that particular asset. So if the correct value at the date of death for this property was £500,000, and subsequently the beneficiary of the property sells that for £550,000, they would have acquired it at the market value at death, the £500,000 probate value, and so there will be a £50,000 capital gain. And the only issue there is whether you might want to argue that the probate value of 500,000 should in fact be amended on the basis that the actual sale proceeds that were achieved shortly after death were 550,000. But why would you want to do that? Ordinarily you wouldn't, because ordinarily we'd be looking, and that's the implication from the information in this case, at a choice between, well, I say choice, at alternatives of inheritance tax at 40%, or capital gains tax at a maximum 28%. And so if the value of the property, the additional value, would be subject to IHT at 40%, then I think if you subsequently sell it a few months later for 50,000 more than that, you would be content and prefer to pay capital gains tax on that additional gain. In a different scenario, it might be that the residential nil rate bands, and I say bands in the plural because the questioner indicated that the deceased's late husband's nil rate band, residential nil rate band rather, had not been used. Well, if the residential nil rate bands had not been fully used, then you would of course prefer to have a higher value in the estate so that you've got IHT at 0 rather than capital gains tax later at 28%. But I'm not suggesting that it's a choice. We need, as a matter of fact, to establish the values at death.
We would be very happy if probate was on the high side, if we had lots of nil band left. But if it is going to be subject to capital gains tax, if it's going to be subject to tax on top of the nil rate band, we would be very happy to be at CGT and not IHT, actually, because, as you say, of those lower rates.
That's correct.
Just because inevitably people worry about it. You said 28%. Somebody inevitably has sat and said, oh, I thought it was 20 now, but because we are talking of
residential property or a dwelling, the capital gains tax rate would be 28%, unless it's for an individual where it's covered by basic rate band, and it would be 18.
Okay.
One point made by one of the contributors to accountingWEB was that if the inheritor of the property, the son of the mother, were to move into the property and occupy it as their private residence, then for at least a period, then on an eventual disposal, the last 18 months worth of gain, that's from the date of the death through to the eventual disposal, as a proportion that would be exempt under the main residence. But we need to make sure those conditions are properly met. And another contributor, I think, also made the point that the increase in value could be covered, or at least in part covered, by the capital gains annual exemption.
Very true, very true. The second question this month is from Bernard Michael, who has asked a question which, after about 5 seconds, I decided was the easiest question we'd ever been asked and was therefore not worthy of going in. But as I read on, I decided it was much more interesting. My initial answer, the question was to do with the child benefit high income charge. And the question, of course, is on whose return does it end up going? The answer is, well, the higher paid, the end. However, a new client has been claiming child benefit and has a taxable income of £60,451 for 17/18. When asked if her partner earns more than that, she said that in the tax year she'd live with two different people. At the beginning of the year for 5 months, she was at the tail end of one relationship, and then the final 2 months of the year, a new partner had moved in and was still living with her. I've never thought about it. If there are three people involved, what does the answer become then?
Well, first, the basic rules are that if one or other of the couple has income in excess of £50,000, there will be a withdrawal of child benefit if it has been claimed. And the withdrawal is on the basis of 1% of the total child benefit per £100 of excess over the 50,000 limit. And it then takes £10,000 of excess income to withdraw the full child benefit, whether it was one child, 7 children, whatever. So the range of income for the higher taxpayer, which will trigger the clawback of child benefit, is £50,000 to £60,000. As the questioner puts it, the woman who is the mother who is claiming the child benefit has income over 60,000, and therefore the child benefit, high income child benefit charge will apply if she does not tell the Department of Work and Pensions to stop paying it. Of course, the simple answer is to tell them to stop paying it, and then there is no charge. Now, where you have cohabiting couples, they don't have to be married, they simply need to be living together as husband and wife or registered civil partners. Where you've got cohabiting couples, the high income child benefit charge is a tax charge that applies to the individual with the higher income. So if for the first 5 months of the tax year she was living with a partner whose income was 70-odd thousand, higher than hers, then the high income charge would apply to that taxpayer, her partner. Similarly, if after a period of living on her own, she then cohabits with another high income partner whose income is higher than hers, the high income child benefit charge will attach to that new partner, which is quite important. It does then, of course, raise issues as to how much does who have to pay, and it'll be time apportioned, so the first will only be liable in respect to the 5 months in which they were cohabiting, and so it goes on. And in the intervening period, then when she's living on her own, but still claiming the child benefit, she would be liable for the high income child benefit charge. So for one and the same tax year, it's possible that 3 individuals would have to include in their self-assessment returns, or if they're under PAYE, notify the revenue of their high income child benefit charge liability. So pretty complicated. But
and of course, going back to the first, who I think the question actually specified that neither of the two people were in fact the parents of the children for whom child benefit was being claimed. Going back to this guy and saying, oh, by the way, I know you've moved out now, but don't forget to pay this much money back on my behalf. It would be an interesting conversation.
Well, very interesting. And indeed, I was thinking when preparing for this that it is actually potentially quite an important issue for separating and divorcing couples. Suppose that a couple have been married for several years, have 3 or 4 children, and then at the end of April, they separate and the husband moves out. The wife has continued to claim child benefit, and the husband has been reporting the high income child benefit charge on his self-assessment return. Well, for that tax year, he should limit that charge to just 1 month. Now, let's suppose that the wife is not herself a high income earner. So she will be entitled to continue to claim the child benefit with no clawback on her. But maybe 6 months after they separate, we're still in the same tax year, a new man moves in with her, as has happened in this case. Well, the new individual, if the new partner, if they earn more than 50,000, certainly over 60, they're then going to be subject to the high income child benefit charge. And if I was the husband who'd been kicked out, as it were, I might want to make sure that, I mean, the whole thing is a nightmare, isn't it? But you can see where I'm going with
It is something that
a bit more complicated than you would like.
Has to be considered. What a tangled web we weave. The important thing is to pick up on exactly how the administration will work in both of our questions this month. Do keep posting on the Any Answers section, and we will perhaps pick your questions next month. For this month though, bye-bye.